Good morning, sir. This is DNS Kaushik 19 BC 1363. Today I'm going to discuss about Bitcoin, what is its history, and the technology that Bitcoin uses, and the risk and regulation involved in Bitcoin transactions, and finally the advantages and disadvantages of cryptocurrencies. Now let's go into the topic. What is Bitcoin? Bitcoin is a cryptocurrency, a virtual currency designed to act as money and a form of payment outside the control of any one person, group, or entity, and thus removing the need for third-party involvement in financial transactions. It is rewarded to a blockchain miners for the work done to verify transactions and can be purchased on several exchanges. Bitcoin was initially introduced in year 2009 by an anonymous developer or group of developers using the name Satoshi Nakamoto. It has since become the most well-known cryptocurrency in the world. Its popularity has inspired the development of many other cryptocurrencies like Ethereum, Dogecoin, Shibu, and many more. These competitors either attempt to replace it as a payment system or used as utility or security tokens in other blockchains and emerging financial technologies. History of blockchain. In August 2008, the domain name bitcoin.org was registered. Today, at least this domain is who is God protected, means the identity of the person who registered it is not public information. In October 2008, a person or group of persons using the name Satoshi Nakamoto announced the cryptography mailing list at meltdown.com. I have been working on a new electronic cash system that fully peer-to-peer with no trusted third party. This is the famous white paper published on bitcoin.org entitled Bitcoin, a peer-to-peer electronic cash system, would become the Magna Carta for how Bitcoin operates today. On Jan 3, 2009, the first Bitcoin block was mined, the block 0. This is also known as Genesis block, and it contains this text: the times 03 Jan 2019, Chancellor on brink of second bailout for banks, perhaps proof that block was mined on or after that date and may also as relevant political commentary. Now let's see what is blockchain. Bitcoin's blockchain technology. Cryptocurrencies are part of a blockchain and the network required to power it. A blockchain is a distributed ledger, a shared database that stores data. Data within the blockchain are secured by encryption methods. When a transaction takes place on the blockchain, information from previous block is copied to a new block with new data encrypted, and the transaction is verified by validators called miners in the network. When a transaction is verified, a new block is opened and Bitcoin is created and given as reward to the miners who verified the data within the block. They are then free to use it or hold it or sell it. Bitcoin uses SHA-256 hashing algorithm to encrypt the data stored in the blocks on the blockchain. Simply put, transaction data stored in a blockchain is encrypted into a 256-bit hexadecimal number. That number contains all of the transition data and information linked to the blocks before that block. Transactions are placed into a queue to be verified by the miners within the network. Miners in the blockchain network all attempt to verify the same transaction simultaneously. The mining software and hardware work to solve the nonce, a 4-byte number included in the block header that miners are attempting to solve. This block header is hashed or randomly generated by a miner repeatedly until it meets a target number specified below the blockchain. The block header is solved and a new block is created for more transactions to be encrypted and verified. Now let's see what is blocks and all the details about the blocks. When a block on a blockchain is open, the blockchain creates the block hash, a 256-bit number that encodes the following information: the block version, that is the block client version, the previous block's hash, the hash of the block before the current one, the coin-based transaction, that is the first transaction in the block issuing the Bitcoin reward, and the block height number, it denotes how far numerically the block is from the first block. And numerical root, it is nothing but a 256-bit number that stores the information about all previous blocks. And timestamp is the time and date the block was open. The target in bits is nothing but the network target, and the nonce, it is nothing but a randomly generated 32-bit number. Now let's see what is Bitcoin mining. How to mine a Bitcoin. A variety of hardware and software can be used to mine Bitcoin. Bitcoin was first, when it released, it was possible to mine it competitively on a personal computer. However, as it got more popularity and many other miners joined the network and the competition to mine the Bitcoin is increased, then it is the difficulty level to solve a mathematical puzzle and to do the mining process became difficult. And this is because many people joined this mining techniques, and they are using some application specific integration circuit which has been built for mining that can generate around 255 trillion hashes per second. In contrast, a computer with latest hardware hashes around 100 mega hashes per second. To successfully become a Bitcoin miner, you have several options. You can choose your existing personal computer to use mining software compatible with Bitcoin and join a mining pool. These mining pools are group of miners that combine their computational power to compete with large ASIC mining firms. If you have a financial means, you can also purchase an ASIC miner. You can generally find a new one for around $20,000, but used ones are usually sold by miners as they upgrade their own systems. There are some significant costs such as electricity and cooling costs to be considered if you are purchasing one or more ASICs. There are several mining programs to choose from many pools you can join. Two of the most known programs are CG Miner and BFG Miner. When choosing a pool, it's important to make sure that you find out how they pay out rewards, what any fees might be, and read some mining pool reviews. Mining rewards for successfully completing one block. You can see that in 2009 it was 50 Bitcoins, and after that in 2012 it was 25 Bitcoins, and after that it became 12.5 Bitcoins, and after that it becomes 6.25 Bitcoins. So you can clearly see that on an average, the Bitcoins rewards that you are getting are becoming half for every 4 years, or for every 210,000 blocks are created. You can clearly see that how this is falling for every 4 years. And what is the Bitcoin mining max puzzle? At the heart of the Bitcoin mining, it's a max puzzle that the miners are supposed to solve in order to earn Bitcoins. The puzzle is called proof of work, a reference to the computational work expected by miners to mine Bitcoin. Though it's often referred to as complex, the mining puzzle is actually fairly simple and can be described as guesswork. The miners in the Bitcoin's network try to come up with a 64-bit hexadecimal number called a hash that is less than or equal to the target hash in SHA-256. Bitcoin's proof of work algorithm, a miner system use considerably brute force in the form of multiple processing units stacked together and split out the hashes at different rates, mega hashes per second, giga hashes per second, or tera hashes per second, depending upon the unit, guessing all possible 64-bit combination until they arrive at a solution. The system that guesses a number less than or equal to the hash are rewarded with Bitcoin. Here's an example to explain the process. Say, let's you ask your friends to guess a number between 1 to 100 that you have thought of or written down on a piece of paper. Your friends don't have a guess to the exact number, they just have to be the first person to guess a number less than or equal to your number. Let's think, if you are thinking of a number 19 and a friend comes up with a number 21, they lose 21 because 21 is greater than 19. But if someone guesses 16 and another friend guesses 18, the later wins the game because 18 is more nearer to 19 than 16. In very simple terms, the Bitcoin mining match puzzle is the same situation described above, except with 64-bit hexadecimal numbers and thousands of computing systems. What is mining difficulty? Mining difficulty refers to the difficulty of solving the max problem and generating Bitcoin. Mining difficulty influences the rate at which Bitcoins are generated. Mining difficulty changes every 2016 blocks or approximately every 2 weeks. The succeeding difficulty levels depends upon how efficient the miners were in preceding cycle. It is also affected by the number of new miners that have joined Bitcoin's network because it increases the hash rate or the amount of computing power deployed to mine the cryptocurrency. In 2013 and 19, as the price of the Bitcoin rose, more miners joined the network and the average time to discover the block of transaction fell to 9 minutes from 10 minutes. But the opposite can be true. That is, the more miners are competing for a solution, the more difficult the problem will become. If computational power is taken off the network, the difficulty adjusts down to make the mining easy. The difficulty level for mining in March 2022 was 27.55 trillion. That is, the chances of a computer producing a hash below the target is 1 in 27.55 trillion. To put that in a perspective, you are about 91,655 times more likely to win the Powerball jackpot with a single lottery ticket that you are to pick the correct hash on a single try. What are the economics of mining Bitcoin? Electricity. This is the power that runs your mining systems 24/7. It can run up to a substantial bill. When you consider that the process consumes as much electricity as certain countries do, the cost can work out to be pretty big. Mining systems. Contrary to the popular narrative, desktop computer and regular gaming systems are not fit or efficient for Bitcoin mining. The process can heat up such systems and cause bandwidth issues in a home network. Application-specific integrated systems, which are customized machines for Bitcoin mining, are the main infrastructure investment for Bitcoin miners. The price range for such machines can range anywhere from $4,000 to $12,000. Even with such high costs, a single ASIC equipment system generates less than a single Bitcoin. Bitcoin miners organize thousands of ASIC systems into mining pools that run 24/7 to generate 64-digit hexadecimal number required to solve a hash puzzle. Network infrastructure. Network speeds not make a marked difference to the Bitcoin mining process. However, it is important to have an internet connection that is available by 24/7 without any interruptions. The connection should also have a latency from the nearby mining pools. Dedicated networks reduce external dependency and ensure that latency is minimized. Going offline doesn't necessarily stop the process of syncing transaction, but it can make the process time-consuming and possibly prone to errors after connection has resumed. Risks of investing in Bitcoin. There is regulatory risk. This talks about lack of uniform regulations about Bitcoin and other virtual currencies, raises questions over their longevity, liquidity, and universality. Security risk. Most individuals who own or use the Bitcoin have not acquired their tokens through mining operations. Either they buy and sell Bitcoin and other digital currencies on popular online market known as cryptocurrency exchanges. Bitcoin exchanges are entirely digital, as with virtual system, and are at risk from hackers, malware, and operational glitches. Insurance risk. Bitcoin and cryptocurrencies are not insured through the securities Investor Protection Corporation, SIPC, or Federal Deposit Insurance Corporation, FDIC. Some exchanges provide insurance through third parties. In 2019, prime dealer and trading platform SFOX announced that it would be able to offer Bitcoin investors with FDIC insurance, but only for a portion of transactions involving cash. Fraud risk. Even with the security measures inherent with a blockchain, there are still opportunities for fraudulent activity. For instance, in July 13, the SEC brought legal action against an operator of Bitcoin-related Ponzi scheme. Market risk. Bitcoin values can fluctuate a lot. Indeed, the value of the currency has seen wild swings in price in a very short period of time. Subject to high volume buying and selling on exchanges, it is highly sensitive to any newsworthy events. According to CFPB, the price of Bitcoin fell 61% in a single day in 2013. While the one day the price drop recorded in 2014 was big as 80%. How long it takes to mine one Bitcoin? It takes an average of 10 minutes for mining network to validate a block and create the reward. The Bitcoin reward is 6.25 BTC per block. This works out to be 100 seconds for one Bitcoin to be mined. What happens after all 21 million Bitcoins are mined? After the maximum number of Bitcoins is reached, even if that number is ultimately significantly below 21 million, no new Bitcoins will be issued. Bitcoin transactions will continue to be pulled into blocks and processed, and Bitcoin miners will continue to be rewarded, but likely only with transaction processing fee. Bitcoin reaches its upper supply limit is likely to affect Bitcoin miners, but there are affected depends in part on how Bitcoin evolves as a cryptocurrency. If the Bitcoin blockchain in 2140 year processes many transactions, then Bitcoin miners may still able to generate profits only from transaction processing fee. If Bitcoin in 2140 year largely serves as store of value rather than daily purchases, then it's still possible for miners to make profit. Even with low transaction volumes and disappearance of block rewards, miners can charge high transaction fees to produce high value transactions or large batches of transactions with more efficient layer 2 blockchains like Lightning Network working in conjunction with Bitcoin blockchain to facilitate daily Bitcoin spending. But if Bitcoin mining in the absence of block rewards ceases to be reliably profitable, then some negative outcomes can even occur. Miners from cartels. Group of miners may collide in an attempt to control mining resources and command higher transaction fees. Self-mining may occur. Miners engaging in selfish mining collude to hide new valid blocks and release them later as orphan blocks that are not confirmed by blockchain network. This practice can increase block processing times and ensure that high fees are paid for new blocks when they are finally released to the blockchain. Now let's talk about what are the advantages of blockchain or Bitcoin. Though Bitcoin has not become that popular as currency, it could be a foundation for future revolutions in the payment system, which is faster, cheaper, and secure. It could become easier to carry out international transactions. It can be used in emerging countries with a dysfunctional financial system. An organization called Stellar is already using this technology in countries like Nigeria and Africa to provide affordable financial services. The technology used in blockchain could be used in other areas like transferring ownership of a property, debt, shares, etc. It will eliminate all the intermediaries involved in such transactions. What are the disadvantages of Bitcoin? As it is anonymous, it can become a medium of transaction in illegal trade and drugs dealing. It can be easily used in money laundering. It is difficult to store Bitcoin safely as wallet can be hacked. The transaction once done and recorded on blockchain cannot be rolled back. If you lose your private key, you will lose all your Bitcoins. There is no way of getting the key and the coins back. Bitcoin is highly volatile currency. So it is up to you to decide whether to invest in Bitcoin or not. But I suggest it's all depends on your opinion on Bitcoin and your financial ability to invest in Bitcoin, and what is your risk and what are your financial goals and what are the present situation in the market, and how is the demand and supply for the Bitcoin, and how the news is flowing into the market, like whether it is good or bad, or how the cryptocurrency is evolving in future. And based on all these things, you need to consider whether to invest or not. And it totally depends from person to person. Every person has different perspective on Bitcoin and cryptocurrency. So it's up to you to decide whether to invest in Bitcoin or not. But Bitcoin and blockchain are evolving at super fast. And thank you.